Just letting everybody know we're going to start here shortly. We've got about 20 seconds till the top of the hour. We'll get started promptly, but I wanted to start letting everybody in. Appreciate you all being here today. We got a pretty big crowd signed up for this one, which kind of expected. It's a topic that's fairly interesting and a topic we were hoping we would never have to talk about. But the way we stand right now, we are going to have to talk about it, and that's why you're all here today. I can still see a bunch of people jumping in. So while that's happening, I'm going to give it a few extra seconds to before we officially kick it off. But technically, we have gone live. In fact, you know what? I'll do some housekeeping while people are logging in still. So a couple things. You are assuming that you signed up for an update on the 174 capitalization rules. You're in the right spot. 174 meaning R&D expenses or R&E expenses. It depends on which way you say it, research and experimentation or research and development. We live in a time where we now have to capitalize these expenditures. So this is today's webinar. We have people who've logged in from two different places, from our website, our Tri-Merit webinar space, and from CPA Academy. So if you're on one of those or the other, you'll get your CPE certificate all coming straight from Tri-Merit. I want to set the stage for that. This is available for 1 hour of CPE. To get your CPE, you're going to have to stay logged in for 50 minutes. And so I know some people are still logging in now. So obviously, make sure you stay in for 50 minutes, 50. Make sure you answer the polling questions, 3 of 4 of them at least. We'll have 4 polling questions that I'll pop up. I will announce during the presentation. And so you'll hear those polling questions. I do see some people are already talking on Q&A and chat. I assume everybody can hear me. So just in the chat, just make sure that you can hear me. You can see my slides titled Update to 174 before I really get into it. If a few people can confirm that, I would really appreciate it. Yes, thank you. Some of my favorite people answering. I can recognize names here. So this is great. Thanks, everybody. All right, so CPE. Stay logged in, answer the polling questions. Your certificate will be mailed from Tri-Merit, not CPA Academy, but from Tri-Merit sometime, and Mark can chime in, but I assume sometime next week you'll get those certificates and it'll go to the email address you registered with. So if it wasn't your business email address, make sure you check the email address you registered with. All right, housekeeping done. Let's move on. Let's do some quick introductions. You can see 4 people on the screen right now. One of those is me. I've done these presentations quite often on our website and CPA Academy as well. So appreciate their partnership with us on this. Just a little background on myself. I am a CPA. I was managing partner of a CPA firm in the Chicago suburbs for about 18 years before merging that in with another firm and starting Tri-Merit. Tri-Merit's a specialty tax firm. We can go deeper into that. I host a podcast. I do some other things. There you can see. In addition, with me today, the other person that will be speaking is Phil Williams. He'll jump in a couple times. Phil is a partner with Tri-Merit. Phil has a lot of initials after his name, which means he's gone to a lot of school. One of those is he is a lawyer in addition to a mechanical engineer. So Phil heads up all of our service line offerings from a project management side of things, and that's 6+ different service lines we deal with. And he leads our audit defense team. In addition, I've got Nick Pantaleo and Barry Devine. They will be behind the scenes answering questions. So if you do have questions today, please put them in Q&A. They will be checking that. Chat would just be for more communication between people. But if there is a question, specific question, put it in Q&A. And I think we will get quite a few questions today, just because it's a topic that there's a lot of unknowns on. We're going to clarify things as much as we can for you with as much information as we have. There's some things we still need clarification from IRS on, and so we will wait for that, but we do have some decent information to share on where we are today. So, Nick and Barry will be answering those questions behind the scene, and probably during polling questions, they will pop in and maybe read some questions that maybe we address live. Last little tidbit before we jump in. is, I mentioned Tri-Merit's a specialty tax firm. What we do is we support tax preparers by really trying to be an extension of their advisory team, and advisory is important. Everything we do brings tax saving opportunities to your clients, and so advisory obviously is such a key word. From day one, we've decided we're going to spend more time qualifying, quantifying, and documenting credits and incentives, so we spend less time, defending. That's pretty pertinent right now with one of the credits we deal with, which is ERC. I'm not going to go into ERC, but you all know there's a lot of misinformation on that. In fact, I had an article published in Accounting today about that misinformation. So if you want to go take a look at that. I want to just point one thing out on our services. Besides this, we do R&D, cost seg, work opportunity tax credit, energy incentives. This is what I want to point out. The Inflation Reduction Act really defined or enhanced a bunch of different energy incentives. We do have a service offering around 45L and 179D, and now in addition, investment and production tax credits. So take a look for that. There'll be some potential saving opportunities for your clients. Just point out, we because of all of our partnerships with firms like you, we've been able to be named one of the fastest growing privately held companies. All right. Agenda. What are we going to do today? It's all 174. 174 meaning R&D or R&E expenses. We're going to set the stage of what it is, the history, why we're here, what's the current issue. There is a definite interplay between the R&D tax credit and other tax impacts as well. We'll go over that. We'll go over some planning considerations and then talk about how we initiate this in this first year, things we need to do. So that's the agenda. It's really all 174. All right, before we jump in, we're going to go right away with the polling question. I'm going to kick this off. So if you make sure you're paying attention, we are going polling question, launching polling question right now. Have you used the new 174 capitalization rules and tax plannings for 2022? Have you used this already to communicate with clients that, that there is a potential for an increase in tax for them this year? And the majority are coming in as no, which is what I expected. We never expected to have to do this. We knew this was defined a while ago, but we assumed that this would go away. And man, we're a lot of taxpayers are in a bind right now because this is going to affect a lot of them. All right, we've got still some more votes or answers coming in. Make sure you put this in. We got 93% of you responded. I'm going to end this poll here in about 4 seconds. So if you haven't put your response in and you want CPE, get your response in. I'm always amazed that another one goes in right when I say that, another one there, but I'm going to end the poll right now. So polls ending with 69% saying no, you have not used this in tax planning yet, which I'm not surprised about. A lot of people have just not ignored it, but just assumed that this would never come into play. So we didn't have to think about it, but it is a tax planning issue that we need to really be looking at. All right. So this is the gist of it. The gist of it is we are required to capitalize 174 expenses starting this past year. What is a 174 expense? This is the big question. It really is the big question. What is a 174 expense? I can define R&D tax credit expenditures, which are defined in Code Section 41, pretty easily. And to qualify as a 41 expense, an R&D tax credit expense, you have to qualify for 174. The problem or the issue is there's a lot more expenses that qualify for 174 than qualify for 41. So we have this small pool of expenses for the R&D tax credit. We have this large pool of expenses for 174 in general. The definition is not that succinct. They don't go into much really deep on the definition of what an R&D expense is. But what we do see is that it says all cost incident to the development or improvement of a product, process, technique, pilot formula or pilot model, formula, invention, patent, or similar property. So all the cost incident to that. for R&D tax credit, it's 4 simple expenses. For 174, it's all these. And so what does all mean? What does that mean? Well, when we look at it, and again, these aren't really well defined, but when we look at it, it's, the cost of attainment of a patent, the attorney fees, wages. For the R&D tax credit, it's wages, box 1. For 174, it's wages fully burdened. We're looking at the non-taxable benefits as well. 174 expenses include utilities, overhead, patent expenses, materials, rents, depreciation, software development costs, regardless of whether these costs are on a product that we're going to use internally or we're going to sell. If it qualifies with uncertainty and experimentation, these are expenses that go into 174. So you can see that's a very broad definition of expenses. We're going to go deeper into that as we talk today, but this is not cut and dry. This is determining overhead. This is how do we allocate expenses from our manufacturing shop floor that really should be a portion of overhead allocated to an R&D expenses. These are things we're going to talk about and see what methodology we should do with this. There's almost a better definition of what is not R&D than what is. What is not a 174 compared to what is a 174. And so the nots are the cost to acquire an existing patent, not getting a patent on our product, but the cost to acquire an existing patent, not R&D, or a model, or a production, or a process. This is us buying it from someone else, not R&D. Even though it may have involved R&D, it's not our R&D. The cost to acquire or improve land or depreciable property, not R&D, or acquire depletable property, not. Specifically in 174, it calls out oil and gas exploration, not R&D. I mean, there is probably some significant research going into those, but that is called out specifically, not 174. Testing or quality control on a production project, not. Testing or quality on, let's say, a prototype, that would be R&D. Consumer FSC surveys, not R&D. Management studies, advertising or promotion of new products, not considered part of the R&D. And research for literary, historical, or similar projects, not R&D. So those are things where we can say, okay, these are not R&D. We had a few we can say are R&D. When they made these new rules put in place, they actually add a section to 174 defining software specifically as an R&D project. So we know that specifically is R&D. That specifically is 174. And then we know that these other areas of research and development and the manufacturing setting, that type of thing, is R&D. So how did we get to this point then that we're at today and why we're talking today? Well, let's do a little history on 174, R&E expenditures. Prior to 1954, prior to the IRS Revenue Code of 1954, if you had R&D expenses, you were required to capitalize these and amortize or depreciate them over the useful life. So you had to be able to determine the useful life of these expenditures. If you couldn't determine the useful life, then you had to basically just let them sit there on the books until you either sold them or disposed of them or decided it wasn't going to work. Then you could write them off. So this was the rule prior to 1954. 1954 came and this new code section was put in. 174 was put into the IRS code. And in there, it said if we have research and experimentation expenses, we can either deduct them in the year they're incurred, or we can amortize them for a period up to 60 months. This is pretty much the rule that we've lived under for the last 70 years, that we could, and for most of our taxpayers, deduct R&D expenses as incurred. And most of our taxpayers, most of our clients don't even know what an R&D expense is because of this rule, because they never had to determine what qualifies as an R&D expense, because it didn't matter. It was a write-off. It was an expenditure. And so nobody really paid attention to that. There was a couple other changes that happened over the life of 174, and there's some major ones, there's some small ones. And again, this is 70 years now, almost 70 years we've been dealing with this. In 1989, they added 174E, which basically said to be able to deduct these 174 expenses, they had to be reasonable under the circumstance, which is a very succinct definition. As you'll see with much of this with 174, that is so exact, reasonable under the circumstances, but we had to put that in place. We had to make sure these expenses were reasonable in order to take this current year deduction on them. In 2014, a pretty major change happened and some regulations came out that said, hey, if we are developing a prototype, a pilot model, that has uncertainty, the entire process, and this is important because this is going to directly affect these new 174 capitalization rules. But in 2014, it said, hey, if we have uncertainty, the entire process of developing this prototype / pilot model, it doesn't matter what the outcome of that was. Everything that went into that prototype and pilot model is a 174 expense. So it increased the amount of expenses that we could deduct immediately as a 174 expense if we had this uncertainty the entire process. There was a shrink back rule in this that said, hey, if that uncertainty ended, 80% of the way through the project, well, that's where 174 expenses ended. Then the rest of the expenses would be includable in maybe ordinary and necessary and cost of goods sold and somewhere else. But that's where 174 would stop. Before this rule, what they had said is, if we have an R&D prototype project and that ends up being successful and we sell it, we waited till the outcome of that project. We determined what the outcome was, and then we determined what the expenses were. In this scenario, if we sold it, it would have been a cost of goods sold. In this scenario, if it was let's say a piece of machinery that had R&D uncertainty, we ended up using it internally, we would have capitalized it and depreciated it. No longer the case with these new rules in 2014, these new regs. Now, if there's uncertainty, it doesn't matter the outcome of that product. All the expenses that went into there are R&E expenses, research and experimentation, and therefore up until January 1st of 2022, they were all deductible as incurred, which was great. I mean, that was a nice benefit, and it increased the amount of supply costs potentially that went into the calculation of 41, the R&D credit. Now, why we're here now today is that was all said and good. We were living happy, deducting our expenses, getting our R&D tax credit, even reducing expenses more. Come the Tax Cut and Jobs Act of 2017, there was an amendment to 174 in there. And this amendment said, hey, and I'm paraphrasing, and I'm probably putting words in Congress's mouth here. So it said, hey, because we have all these tax cuts in the Tax Cuts and Jobs Act, we need to figure out a way to pay for those. Okay, here's one idea. Let's defer this change until 2022, but let's put a change in place that says starting December 1st or January 1st of 2022, our taxpayers are no longer going to be able to deduct R&D expenses. They're going to have to capitalize those and write them off over. The rule is 60 months for domestic R&D expenditures, 180 months or 15 years if it's a international R&D expenditures or R&E expenditures. So they defined it in 17 as a way to pay for the Tax Cut and Jobs Act. We all knew, everybody on this presentation, everybody that is sitting on this end of the screen, we all knew this was never going to kick in. This was just a way to say, hey, okay, we've made this balance. We've paid for the Tax Cut and Jobs Act. Now let's work on changing this rule before 2022 came around. We all know this didn't change. So, but that's how we got here. It depends on the scoring method you use. This amendment was intended to generate anywhere from $15 to $150 billion in revenue over a 10-year period. So it was a significant revenue generator. The problem is they didn't think about the economy impact. Our economy is based, our part of our economy is based on us being technologically advanced, doing R&D projects, bringing on new products into the economy, hiring individuals from a science standpoint, from a manufacturing standpoint, from a whatever standpoint to come in and work on these projects. So in my mind, the R&D expenses, R&D credit are more than just a benefit to taxpayers. It is really, in my mind, also an economy stimulator, a jobs incentive as well. There, I got out my soapbox for probably not the first time today. We will see. So the problem that we're having with this Tax Cut and Jobs Act is, as I said, this was never going to kick in. We all knew it wasn't going to kick in. And because it wasn't going to kick in, for the first 3 years after this was defined in the Tax Cut and Jobs Act, I was talking about it in every presentation I did. The last couple of years, I started taking it out, just mentioned, hey, this is coming, but we all expect this to go away. I think that mindset was pretty much what everybody had. And so the biggest problem that we have right now is nobody knows what a 174 expenditure is. We gave you a definition at the beginning. We're going to give you more definitions as we go, but nobody's had to identify. I'll guarantee you, if I ask you to raise your hands right now and say how many of your clients identify research and experimentation expenses separately on their financial statements, let alone their tax return, their financial statements, there's not going to be many people that raise their hand because nobody's had to do it. We haven't had to worry about what a 174 is because it's been buried in salaries and wages. So boom, we can deduct salaries and wages. No big deal. We can deduct 174. It's been buried in supply cost. It's been buried in overhead. It's been buried in all these other places, which didn't affect the bottom line tax return because we didn't have to pull them out. Now we do. Now we all have to get educated on what a 174 is and how are we going to identify those from a tax requirement standpoint going forward. And we have to do that. Because we have to do that, what's going to be the income tax effect? We're going to do just a quick math. We're going to go more in depth here in a second, but we're going to do a quick math on this. Let's assume we have a taxpayer that has $2.5 million of income before 174 expenses. So I say net income before 174. In 2021, let's say they were able to deduct $1 million of 174 expenses. They had taxable income of 1.5 million. They had 21%. They had $315,000 of tax. That same scenario, but now fast forward to 2022, a year later, no longer can they deduct those 174 expenses as incurred. They're amortized over 5 years, but technically it's 6 because it's a mid-year convention. So we get 10% of those expenses the first year. In this scenario, that's $100,000. The second year, we would get 200,000, 200,000, 200,000, 200,000 4 times. The last year, which would technically be the 6th year, would be our final 100,000. So it's really amortized. It's a 5-year amortization, but mid-year convention. So 6 tax returns that will affect. This first year, we're going to add net of $900,000 of additional taxable income to this taxpayer. That increases their tax to $504,000. This, let's say, $8 million manufacturer, which is probably not an uncommon number for $1 million of expenditures, just increase their taxable income, or just increase not their taxable income, but their tax at corporate rates. Now, if this is a pass-through, it's even going to be greater, but at corporate rates, they increase their tax by what's that, $189,000. And so that's a significant impact. That's why I asked at the beginning if you've used this in tax planning, not saying that you should have, because we all expect this to go away, but this is something where we're going to, if we haven't already, this is something we're going to have to sit down with clients immediately and discuss this. One, what do they do? Where's R&D? And then what's the tax impact on that? And we'll give you some more advice, because what we're seeing is that IRS is going to give us some more guidance on this from what a 174 is, but they're not promising this until March or April. And so at this point, we may be looking at extending anybody who you think has 174 expenses. All right, polling question number 2. Let me pop that up. Give me 1 second. Let's get back to polling question number 2. All right. Have you set expectations with your affected clients, if you know who they are, that their 2022 tax bill will be increasing? We got quite a few people on here, so this is going to go for a while, but you're answering very quick, which is awesome to see. That means you're paying attention, which is great. Barry, Nick, if there's any questions you want to address, let me know. Otherwise, I'll be moving on. If I don't
think any at this time. A couple people have asked about handouts. We do send those out with the CPE certificates. So if anyone's wondering for those, but besides that, we'll get any other questions prepped for later.
Okay, and we're 94%. This is where we were last time when I ended the poll. So I think that's about everybody that wants to participate, I guess, in CPE. And again, as I say that, 2 more come in, but we have a big audience today, so that's to be expected. All right, I'm going to give you 3 more seconds to answer this polling question. 3 more seconds. 3, 2, 1, 95% of you responded. I'm going to end the poll, and 56% of you have said no, you have not used this to set expectations for your clients yet, that their tax bill could be going up. Which is, again, I didn't expect anything less. It is something we were hoping that we wouldn't have to deal with. All right. Let's talk about this from a R&D tax credit standpoint for a second, and then we're going to show you some interesting things with this. And we're going to go back and forth with what is 174 and what is 41 as we go through this discussion as well. And we'll get deeper into the 174. So the R&D tax credit does not affect whether an expense is a 174 expense or not. To qualify for the R&D tax credit, and this is, I'm going to stress this because I've been hearing people say, well, we're not going to take the credit because we don't want to identify we have 174 expenses. Whether you identify it or not, a 174 doesn't change its stripes because you didn't take an R&D tax credit. In fact, if you don't take the credit because you don't want to identify 174, then you are filing an incorrect tax return. That tax return is subject to preparer penalties. It's subject to taxpayer penalties. I don't know the numbers off the top of my head, what that would be, but that's not something you want to do. If you think there's 174, you have a responsibility to dig in there and find that. So the credit can still be taken, and the credit doesn't get affected by the amortization amount from a standpoint. We use the same expenses we always used. And so we'll talk about that in a second. But a 174 expense is different than a 41 expense. 41 has to qualify under 174. And therefore, if you have R&D expenses, if you have 174, you really need to look at the calculation of an R&D tax credit too, because at least that'll help offset some of this additional tax burden. And as we'll see in a second, this tax burden honestly isn't permanent. I'll take that back. It is permanent, but it's temporary. So we're going to get this tax hit for the next 5 or 6 years. All things being equal, we'll even out after that time because we'll have 5 years of amortization. If we're a growing company, we'll still be behind. But if we're a stable company, that expenses will have 100% of amortization each year, and that'll end up evening out. So even though it's not a permanent hit, it is, I shouldn't say that, even though it's some cases a temporary hit, it is a permanent increase in tax for that 5-year period or 6-year period, depending on when we, if we're growing or not growing. All right, that interplay with R&D that I mentioned. So the one thing Congress did when they defined this new rule is they made a conforming amendment in Section 174 and in 41, because without this amendment, the way 41 was written, our R&D tax credit would be based on the amount of 174 expenditures, 174 expenses on the tax return. And if that was the case, that number would shrink dramatically and our R&D tax credit would go away. And so what they did when they defined the Tax Cut and Jobs Act, they changed 41D1A to say we are using, rather than expenses under 174 to do a calculation of the R&D tax credit, we are using specified research and experimental expenditures on 174. Then in 174B, under the same amendment, under the Tax Cut and Jobs Act, they came out and they said, okay, 174B is defining specified research and experimental expenditures, which means with respect to any taxable year, research or experimental expenditures which are paid or incurred by the taxpayer during the taxable year. So it no longer, without this change, it would have read the expenses on the tax return for the year, the 174, which is the amortized amount. But because they made this conforming amendment, we still get to use the total expenses incurred during the year, and therefore our R&D tax credit will not be reduced because of these rules. So they were at least ahead of the game. That they actually made another conforming amendment, which is pretty interesting. Whether they intended this or not, I'm not sure. But what they did is they said 280C. So if you're not familiar with 280C, 280C is out there for a handful of different credits. 280C basically says, rather than, for most credits, what you have to do is you have to reduce the expenses by the amount of the credit. Something you know from ERC, something you know from if you've done R&D before. And so you have to reduce the expenses by the amount of the credit, or you can take a reduced credit. And a reduced credit would be basically 79% of the full credit. The credit's tax affected at a corporate rate of 21%, no matter where you use it. And so they came up with this conforming amendment to 280C that says, well, the only adjustment you need to make is if you don't take the reduced credit, and it probably doesn't make sense to take the reduced credit, but if you don't take the reduced credit, the only adjustment you have to make is if the current year credit exceeds the current year amortization amount, so the current year amortized expense from 174 expenditures, if the credit exceeds that, the adjustment you need to make is reduce your capital account by the excess. So what it doesn't say is you have to reduce the amortization expense, and if there's any excess, reduce the capital account. It doesn't say that. It just says any excess reduces the capital account. And if this is what they intended or not, this is what it says, is that you get to take advantage of the full credit unless it exceeds the amortization amount. You get to take advantage of that. So at this level, it would make no sense to take a reduced credit, because taking the full credit is always going to be a greater benefit. And we reduce some of the amortization if it exceeds the current year credit, but we don't, we overall, there is no time value of this. Overall, we're better off taking the full credit. And in reality, assuming that this doesn't get changed, assuming they don't come out with a clarification that said, sorry, we wrote that wrong, that's not what we expected, and I don't think that's going to happen. My impression is maybe they did put this in there to say, hey, we know we're taking away benefits, but we're going to make it a little more advantageous here because you're going to take advantage of the full credit. It's not tax affected any longer, except the oddball case where it exceeds the amortization, which is not going to happen very much. You were going to give you the full credit so you get this full benefit. Now, after 5 or 6 years, that actually is a permanent additional savings that we're going to have from taking this this full credit rather than the reduced credit. So this was an interesting amendment that they put out there, but in the long run will be beneficial. And so that's one thing that we are obviously tracking as we go. Okay. I told you we'd do this interplay just because we talked R&D now, between R&D expenses and 174, because people are saying, hey, I have a credit. Can't I just use those expenses to identify my 174? It's a good starting point. 41 is a good starting point. The 4 expenses that are included in Code Section 41, the R&D credit, are salaries and wages, outsourced expenses or outside services, supply costs, and rental of computer time. Those 4 are 41, but you can see 174 has a lot more. So salaries and wages, yes, we can use those on 174 that we identified in 41. The problem is 41 is just box 1 of your W-2. It's taxable wages. 174 wages also includes non-taxable benefits. So we already have to make an adjustment there. Outsource costs, if we're outsourcing R&D, prototyping, testing, design, from a standpoint of the credit, we get to take 65% of those expenses into the calculation of the credit. For 174, it's 100%. So now we need to mark that up. We need to take 100%. Supply cost, yes, in both. We get to take that, which the 174 prototype rules increased most likely your 174 expenses because we don't turn it into a cost of goods sold or anything anymore. Positive when it happened, negative now, because now we would rather have those be a cost of goods sold or something else. And we don't get that at this point. Depreciation, let's say machinery we're using in development process, experimentation process, overhead expenses, general and administrative, we have to allocate some of that. Utilities, indirect allocation of expenses, rent, patent cost, all those are under the 174 column that aren't in 41. So you can see, starting with your R&D tax credit expenditures, yeah, that gets you kicked off. That might be a decent percentage too, not necessarily always, but it might be a decent percentage of your credit. But in reality, you're going to have a lot more under 174 than you do under 41. This is a flow chart kind of that we just said, kind of explaining what I just said. All right, start with your 41. If you want to figure out how to advise your clients on what a 174 is, start with 41. Start with your R&D tax credit if you are already doing that. And I'm guessing a lot of you are. And so start there. In addition, then you're going to need to add your non-qualified software development costs and other expenses. So software in general has some limitations on it when it comes to 41. If we're developing a product that has R&D on it, and software by definition, by Code Section 41's definition, is R&D, software development, not all of those qualify for 41, because if it's foreign research, let's say, no, that's not not a credit, but it is a credit for, it is a 174. Or we're developing a product that we're going to use internally for software, which a ton of companies do. I mean, if you've ever been on one of my webinars, you heard I own a bar and a liquor store. I'm a partner in Chicago. We did software development to create an online store. That software development is R&D. That means me as a bar owner, a liquor store owner, has to capitalize expenses on this 2022 tax return because software development. If that software, let's say I could have bought off the shelf, that's not eligible for 41, but the fact that I'm developing internally, it's still eligible for 174. So we have to add that back. We have to add your fully burdened wage cost. It's not just box one of your W-2, as we said, it's all these additional expenditures. Foreign research, foreign research in general is not going to be amortized over 15 years. Foreign research, we don't get to take into 41. Foreign research is a 174 and a longer lifespan for amortization. And then indirect cost. How are we going to allocate overhead? How are we going to allocate utility cost? I think at this point, without further guidance from the IRS, we need to come up with a reasonable methodology. And you all do that in other aspects as well. I mean, figuring out, cost of goods sold based on overhead, you're doing that already. This is going to be that same type of methodology. How do we determine indirect expenses to allocate to 174? So we're going to do that. So this is what we're going to do. We're going to go through this. And part of it is just going through the process. I mean, if you can show you went through this process, you're going to be ahead of 90+% of the tax, well over 90+% of the taxpayers out there that you went through the process to try to determine and allocate 174. As I said, IRS is going to give us more guidance. They're going to dial in this definition of 174 even deeper. There's things that we don't know that we're going to go over in a minute that we're going to need to know. So even though we go through this process of how we're going to advise clients, how we're going to determine what 174 is, I'm going to go back to what I said earlier, and I'm going to probably say this again and maybe again. I think we really need to consider putting clients who we think has 174 expenses on extension. And I know some of you don't like extensions. You don't want to deal with extensions. You want tax season to be over March 15th, April 15th. I think this is the one exception, and that's your call. But this is the one exception where we might want to put these on extension because we are going to get more guidance from the IRS in the next few months. They've told us this. And there's still a chance Congress gets its act together and changes this, although it's looking more and more unlikely. I never would have said that. For 5 years, I've been saying we're not going to have to, well, I wouldn't say we wouldn't have to worry about this because I was talking to people about it, but I was hoping we'd never have to worry about this. All right, one final example then on this. I told you we'd dig a little deeper into an example. So let's do this real quick because this will tell us a few things. One, it's that scenario I said above with the $1 million of expenditures and 21% corporate tax rate. In this scenario, let's say that $1 million was 174. Of that, 800,000 was 41 expenses, R&D tax credit expenses. You can see that first year they have new taxable income of 2.4 million. We went through that. That was $189,000 additional tax because of this increase. Now, in here, I put a reduced credit calculation that I wouldn't do based on what we just talked about under the 280C. And I had made this chart a while ago. I should have changed it before today, but you get the point. The credit, even at a full credit, it's going to be $60,000 or whatever it is. That credit will not offset all the additional tax, but it helps. It offsets a decent amount. If you look come year 5 in 2026, we're actually ahead of the game. From the credit offsetting any additional tax. In year 6, we're back to even. And this is in a scenario where there's no expense increase. Basically, they're flat every year. But under this scenario, we're back to normal. We had a 5-year, 6-year hit of an additional 500, and there's a typo there, but 525,000 additional taxes. But then it's done because from that point forward, unless we are significantly growing, we're going to get pretty much the full benefit because we're going to have a whole 6 years of amortization on our projects each year. Even with the credit, you see this still was a permanent increase to tax of 278,000 over this time. Again, if we're growing, that'll increase. If we're flat, that's what this turns into. Polling question 3. Just letting everybody know I am about. In Siri, we didn't get that, but we're going to launch polling question number 3 now. Do any of your clients segregate our R&D expenses on their financial statements? This is something I mentioned earlier, said there's probably not a ton of them that do, but I'm just curious to see, and we'll talk about if that's acceptable to use then to determine 174 here in a minute. It might be my next slide, actually. That's probably why I put it before this one. But we've got 90%. We were at 95% participation last time. So we need a handful, well, not more than a handful. We got close to 550 people on here. So we need a few more of you to get us to that 95% participation in the poll, assuming you want your CPE. We're at 44 seconds, and that's about as long as I went last time. So I'm going to close this poll here in 3 seconds. Again, announcement, poll is closing in 3, 2, 1. And we hit 95%. All right, ending that poll. And 77% say your clients don't, which to me, 23%, almost a quarter of you have some clients that segregate out R&D expenses. That's at least something. We're starting to identify. And so that'll get us somewhere, but probably not all the way. All right, so we're going to have to implement these changes. We're going to have to start to capitalize. When the Tax Cut and Jobs Act was originally defined, what it says is this is a change of accounting method. For a change of accounting, even though it's mandated, it's a change of accounting method. And because of that, Congress said, we have to, or basically, if you look at tax code, it says we have to fill out a form 3115 change of accounting method in order to implement this new methodology, capitalization rather than expensing of 174. IRS came out with a RevProc just the end of last year that said, all right, and now I'm going to put words in IRS's mouth. And so this is just me assuming that how this went. IRS said, all right, Congress has not got its act together. They have not fixed this 174 capitalization rule. This is going to be such a burden for taxpayers this year and for years to come. Let's make it a little easier for them and at least allow them not to have to fill out a 3115. Change of accounting method, form 3115. If you've ever done them, it's confusing. Like, what section do I fill out? What do I put here? What's this answer? And so IRS has come out and said, no, instead of doing the 3115, basically because you all have to do this, you just need to put a simple statement on that says that you are changing your accounting method. So you don't have to fill out the form. They did give you guidance on what needs to be included in that statement. My guess, well, I'm not guessing. My assumption is that software developers, tax software developers should put this election in there. You know, your tax software, there's a lot of elections. You can go check a box or toggle a switch and the elections automatically goes on the tax return. With this, there's more than just the toggle. You have to answer some questions as well. Hopefully they build this into your software. If they don't, we have put a form together. This is something that I'll see if we can send out. I'll see if it's ready or not. If it is, we can send out when we send the slides and the CPE certificate out to you. If it's not ready yet, if you want to get on our mailing list, we will be putting that out, or you can reach out to one of us later. But it's a simple statement, not a Form 3115 to go forward. So what are the things that we need to consider now? Well, one is obviously we need to know how to identify 174. We've been talking about that. We've given you some guidance on how we can do that. We expect more guidance to come. Do we want to look at, in fact, you know what? I'm going to bring Phil in here because Phil has some ideas on how we can, maybe do some business planning and with this going forward so that we can keep expenses as maybe deductible, even if, but we would have to stop doing R&D. Phil, you want to explain some of the things you think we should be looking at?
Yeah, so thanks, Randy. The two primary areas that we're looking at as far as being able to make non-seismic changes to the business while effectively pulling these expenses out of Section 174. First one is related to contracts. So there is still a requirement that with this development work, with the R&E expenses, that you're taking on risk in the project. So risk in terms of the R&D credit has always been a positive thing. I mean, if you're taking on that risk, it means that if it is funded by another party, that you are able to still claim the credit. Or if you're paying for somebody else to do research, if you're paying them on a fixed fee or a lump sum type of basis, then you're still able to claim those expenses. It's been a good thing. We've been looking at potentially changing that contract language to not take on that risk. Now, there's other things to take into consideration, primarily how those contracts would impact the business in general, but that is one discussion. Another discussion for clients that have a large amount of those foreign development costs is, are there alternatives there? So one of the things that Section 174 specifically calls out as an exception is if you're purchasing intellectual property from someone. If you're purchasing intellectual property, it's not considered research and experimentation. So if there's the opportunity there to have that be structured as a purchase, as opposed to funding development, that is one way to potentially reduce those Section 174 costs. The third one here, which is more complicated, and there are cost considerations as well, would be the reshoring of the international development work. When you look at these changes being put into place, it was pretty clear with the different amortization periods that Congress was shooting for reshoring this work as being one of the goals of the legislation. So those are the three primary areas that we're looking at. Ultimately, the goal being if we can justifiably bring those costs out of Section 174, doing so via a valid method.
All right, thank you, Phil. All right, so I mentioned this last polling question. Do you have any clients that use book R&D expenses or using our financial statements? And can we use those? Well, I mentioned that maybe it's a good starting point. Unfortunately, GAAP rules and Code Section 174 are different. It may give you some guidance in the right direction, but it's probably going to lead to a material distortion of the amount of the 174 if you use that. So at least they've identified R&D. You're still going to need to dig through there and find out what actually is 174 compared to what is a gap R&D, because unfortunately, they're not the same. So just wanted to point that out to you. Will there be other effects to this change on our tax return? There will be. I mean, some simple things like, our taxable income is going to go up. So our donation limitation is going to go up. Our limitation on interest expense will probably be reduced because we're going to have a higher taxable income. We're going to have a higher taxable income, but then we also, under the new rules, we don't get to add back depreciation and amortization. So that may counter adjust it, but together it'll affect the interest deduction limitation. There's going to be an increase to QBI and that deduction potentially for some taxpayers. And then obviously there's state implications. Some of the things with state is a lot of the states basically are following the IRS. They just conform to the IRS rules. And if that's the case, this is also going to reduce the taxable income for states. Some states may pull this out separate. I don't know if we have that list yet on what states are doing something different. If so, you can reach out to us and we'll go with that. But you have to consider state implications as well, because this is just not a federal effect. There are state effects to these changes as well. So what are we doing? Well, I've said this a few times already. We're looking to use that flow chart maybe to determine 174 expenses, but then using that in an extension payment is what I would recommend, and then seeing what the IRS comes out with in the future. If this does change, obviously, and we made an extension payment, we just get that money back when we file the tax return. If this doesn't change, at least we protected ourselves when we put this on extension, that we've got that additional money paid in. What if we underpay it? Who knows what'll happen there, because this is going to be a little bit of a mess for a lot of people. And so we're going to have to see how IRS handles this. As I mentioned too, we need, and Phil just mentioned this, we need guidance. There's a lot of guidance that we need. We specifically need to know more about funded research. Are they going to say that that's not a 174? I assume so, but have they specifically said that? No. In 174, what is that definition? We listed things that we think are in, and things that are specifically out. We know acquiring land is out. We know software is in. We know mine exploration is out, but we need more guidance on what actually is in. How should we have our indirect costs treated? How do we allocate that to R&D projects? And that's the thing specifically at least with 41 and with 174 as well, is they want these expenses to be allocated based on the projects. At least for 41 they do. And so how do we start allocating these overhead costs to these projects from that standpoint? And then does this affect other areas of the tax code? It definitely does. 263A, does it apply? Does not apply? It says allowable deduction under 174. Well, is the allowable deduction the amortization, or is it the entire cost? Is they subject to UNICAP or not? These are more things that does it apply just for the deduction or for amortization? These are things we need to know. We need more guidance on software, even though they said, yeah, specifically 174, new definition in the Tax Cut and Jobs Act is software is to be included in this. They currently state all expenses. What is all expenses? Do we eliminate the uncertainty requirement? Is it just software? It doesn't matter if we have uncertainty or not. What level of the development do we need to perform? Does it include the installation of software that there's R&D on, or does it stop once we've developed? And is the installation still part of that? So there's a lot of questions still to be had there. Let me put up polling question number 4, just so we can get that out of the way. And our timing's pretty good here. Do you plan on putting clients on extension while we wait to see what Congress does on the 174 rules? I should also do a follow-up question on this, which I won't, but is this more extensions than you normally would have done, which I'm guessing is the case. While I leave this up here, just want to say a couple other things, give you time to vote, just as the last one. I want to make sure that everybody gets 3 of the 4 polling questions answered. We have another webinar tomorrow on both sites, Trimerit's website and CPA Academy. It's Cryptocurrency 101. I think it's going to be a pretty interesting topic. We have some guest speakers on that. So if anybody's interested in that tomorrow, that is 1 hour of free CPE for that as well. Matthew May from Acuity will be on that with me, and he is very knowledgeable on this subject. All right, we have less participation in this last polling question. I've let it go longer. 92% participated, but we're over a minute here, so I'm about to close the poll and finish up today's presentation. Ending the poll now, and 72% of you plan on using extensions for this tax season, which I think makes sense. Like I said, IRS has not promised anything to us until March or April. And at that point, it's what can we do? We can't really. If you want more information on this or anything else that we do, you can scan that QR code. Again, you will get this presentation slide deck when we send out your CPE certificate, but you can scan that code. You can go to our website with that scan. You can type in our website. There's our 800 number, our info@Trimerit. You can reach out any of those ways. If you go to the Trimerit page too, there's a meet the team. You can get contact information for other people there as well. And with that being said, Nick, Barry, I just want to see if there's any questions that you want to address live. Otherwise, we will do everything we can to address those questions later on.
There's a couple questions around funded research. If you want to do some quick high-level expansion upon that at all.
Yeah, let's let Phil kick in with that, please.
I thought that one was going to come back to me. So funded research is there's 2 examples. One is when you are paying someone else, you're incurring the expense for the research performed. So you're paying a consultant. If you're paying that consultant on a time and material basis, then generally speaking, and again, I'm making a couple of assumptions in saying this, but generally speaking, that is considered to be at your risk. So it's not considered to be funded research. If you're paying somebody to perform a task on a fixed fee and there's a guarantee as far as what the result is going to be, then that could be considered funded research because the risk has then shifted to that other party. You can address that on the flip side too. And there was one question regarding companies that are doing work under small business grants from the federal government. And those are often drawn to where that company is not taking on risk in the performance of that research. They're doing the research, they're providing a report at the end of the day, but that would be considered funded by the government. So means that they would not qualify for the research tax credit. And we're making the assumption at this point that those expenses would also not need to be amortized over the prescriptive period under Section 174.
Thanks, Phil. Does that address it, Nick?
Yep.
Yep.
The only other question was if you have a crystal ball, Randy, and is Congress going to change this? I hear that one a lot.
So my crystal ball for 5 years has been telling me, yes, my crystal ball might be broken because we have not got to that point yet. So I cannot make a prediction. It makes no sense for these rules to stay in place. It just doesn't. We with the Inflation Reduction Act, we just put a bunch of incentives out there to do R&D, to be innovative, to come up with clean energy, to all this kind of stuff. And this has been our economy. This is what we've done. We've supported innovation in our economy. And then right away after we put out the Inflation Reduction Act and the CHIPS bill, we're going to come and we're going to say, well, yeah, so no longer can you expense R&D. So we really want you to do R&D, but you're not going to get a benefit from it. So let's wash those. It makes no sense. I think they have to act. It's just have to and will are 2 different things. All right. With that being said, I am going to wrap up. Again, I appreciate CPA Academy for being part of this presentation today. I appreciate everybody that signed up there and on our website. And again, if you want to go into cryptocurrency 101 tomorrow, go to try-merit.com, go to our webinars page, and you can register for that. Thanks, everybody.